Howdy, Jacob here. Today we're looking at Alphabet, or what most people know as Google. And so Google owns YouTube, so many other things, and they're everywhere. I don't think I have to do much more saying than that. In the $1.7 trillion market cap, and they were only founded in 1998. That's just crazy right there. 1.6 trillion enterprise value. God, saying trillion is just crazy. I know I did Apple already, but this is just wild. 66 billion in 2014 in revenue to 307 billion in 2023. That's over 400. That's just insane. Um, Margins are actually down a little bit on the growth side, but are up on the operating side. Return on invested capital has been increasing from mid-teens to low 20s. So that's great. They're doing a better job of getting higher returns on the money invested into the business, which you can see through this margin expansion on the operating side. Let's look at the balance sheet. Okay, 110 million in liquid assets with no short-term debt and just 12 million long-term debt. I don't think this company really has to care about dwindling down that debt since they have so little of it. They're reinvesting in themselves immensely. We can see that their capital expenditures have almost tripled. They're acquiring companies actually quite a bit. You're looking at $7 billion, but to them, that's like nothing. So the majority of their cash flow is going towards repurchasing shares. And, does that make sense? If you look historically, again, the history doesn't necessarily mean it's right or wrong, but if you would have bought any time between 2008 to 2018, you look like a genius. And so the return you're getting on that money invested was probably well over 15%. And yeah, their return on invested capital is 20%, but they also make $307 billion. And so what are you going to do with that money? Those revenue from a net income side and free cash flow side, you're looking at well over $50 billion. They probably don't have that many things to invest in. And so to reinvest in themselves through share repurchases can make sense if it's a super cheap valuation, which again, was that during these times? I don't know. But again, it looks like you're right now. So let's start making some assumptions to see whether we think that those were, or I think is a good buy, and then hopefully you do your own analysis to get your own perspective. But for me on the revenue side, they're already so big, but they do everything, and they're so good at expanding into other businesses and getting fantastic returns there. I think that I would not be surprised if they were to be able to grow at, 9% revenue a year for the next 7 years. And then for margin, let's say that, it is going up, so I will maybe do 25, 24. Share change, repurchasing 2% of shares. That's, what is that, 16, 32, about 30 to 40 billion of that free cash flow going towards that. I feel comfortable with that. Then for PE, Google's one of the biggest moats out there. They just do everything. People say Google it, and then YouTube is the just streaming ridiculousness for quick videos and stuff. Okay, so with these assumptions, we get to a price that needs to fall 24%. I would say that, to me, I've done my quick valuations on the Googles, Apples, Meta, Amazon stuff. I think personally that Google is the cheapest right now. But again, I'm a more conservative investor. And so the individuals that are thinking, Tesla or Nvidia growing 50% a year, I just don't see that happening based on, the bigger companies get the less, yeah, they might have bigger moats, which could increase their PE and margins. That it just hinders their growth because they're already so big. But anyways, hopefully you enjoyed the video and have a fantastic rest of your day. Thank you.